History is a circle, not a line. In the cathedrals of high finance, the glass towers of Manhattan, and the glowing smartphone screens of modern retail traders, a specific kind of amnesia persists. It is an amnesia fueled by the most dangerous drug on Wall Street, blind optimism. Legendary investor Sir John Templeton, a man who saw the world through the cold lens of mathematics for nearly 4 decades, once noted that the 4 most expensive words in the English language are, "This time it's different." We tell ourselves these words to justify the unjustifiable. We use them to explain why a company trading at 100 times its earnings isn't a bubble, but a new paradigm. We use them to ignore the wreckage of the past. But as Jesse Livermore, the pioneer of speculative trading, once remarked, there is nothing new on Wall Street. Speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. The story begins in the late 1960s. The United States was basking in the glow of a 20-year economic miracle following the end of World War II. America wasn't just a country. It was an industrial juggernaut. Factories were humming, suburbs were popping up like acne on a teenager. And the middle class was expanding at a rate never seen before. We had conquered the atom, we were racing to the moon, and we had just invented the Etch-a-Sketch. There was a profound sense of American invincibility. Between 1945 and 1970, the US stock market climbed an incredible 350%. This wasn't just a bull market, it was a generation-long validation of the American dream. If you bought stocks, you got rich. It was that simple. By 1972, a new philosophy began to take hold in the wood-paneled offices of institutional banks. Investors were tired of the cyclical nature of the market, the ups and downs of steel, rail, and oil. They wanted something safe. They wanted companies that would grow regardless of the economy. This led to the birth of the Nifty 50. These weren't speculative startups. They were the titans Coca-Cola, IBM, Xerox, McDonald's, and Disney. The logic of the era was dangerously seductive. These companies were so dominant that they became known as one-decision stocks. The theory was that you only had to make one decision, the decision to buy. You never had to sell because these companies were bulletproof. However, if something sounds like a no-brainer investment with zero downside, it is almost always a financial grenade with the pin already pulled. By the early 1970s, the one-decision cult had pushed valuations into the stratosphere. In a normal, healthy market, a solid company might trade at 15 times its annual earnings. But for the Nifty 50, that number was a relic of the past. Coca-Cola was trading at 46 times earnings, McDonald's at 86, and Polaroid at a staggering 90 times earnings. This meant that if Polaroid's profits stayed the same, it would take you nearly a century just to break even on your investment. Collectively, these 50 companies made up roughly 45% of the total United States stock market. The market had become a pyramid, balanced precariously on the heads of a few giants. Then came 1973, and reality arrived like a cold bucket of water. It wasn't just one thing. It was a perfect storm of macroeconomic disasters. The gold standard ended, oil prices quadrupled, and inflation exploded to over 11%. When the economy falls apart, overpriced stocks don't just correct, they get obliterated. The market plunged 50% in the worst bear market since the Great Depression. The one-decision stocks turned into a financial obituary. Coca-Cola shares fell over 60%, McDonald's fell 70%, and Polaroid collapsed more than 90%. This wasn't a quick recovery. It took the market 8 long years until 1981 to simply crawl back to the level it had been at before the bubble popped. Investors were trapped in financial purgatory for nearly a decade. Fast forward to today. If you are looking at the current market and getting a sense of déjà vu, you aren't alone. As Mark Twain once said, history doesn't repeat itself, but it does rhyme. Today's market undeniably rhymes with 1972. We have our own version of the Nifty 50, known as the Magnificent Seven: Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia. These 7 companies now make up around 36% of the entire S&P 500. Every dollar invested into an index fund today is a massive bet that these 7 companies can grow into the ridiculous price tags slapped on them. Just like Xerox and Polaroid before them, these tech giants are innovative and dominant, but they are also being worshipped as if they are immune to gravity. The valuations today tell the same story. Nvidia trades at 50 times earnings. Tesla has seen multiples as high as 240. Investors are once again telling themselves the same bedtime story. These companies are untouchable and will grow forever. But Warren Buffett summed it up best. What we learn from history is that people do unlearn from history. We are staring at a top-heavy market, pretending that valuations don't matter, and whispering the four most expensive words in the English language. We are waiting for the next macroeconomic domino to fall, forgetting that the higher you climb, the harder the floor becomes. The one-decision strategy is a trap because it ignores the most fundamental law of finance. No matter how great the company is, the price you pay determines your fate.